DeFi and its potential to disrupt traditional finance and ensure financial inclusion.
Hi, and welcome everyone. Happy to be here. My name is Ilya, and I'm the research partner at SINOFY. We are a seed venture capital firm, and we exclusively focus on early stage projects, especially in social infrastructure built on top of different chains. And also I'm working as a research colleague with Golub Fund. It's the key market maker for major exchanges, including decentralized and centralized, with 300 plus projects in 2023. Both at SINOFY and Godbit, we usually fully engage with teams which inspired us with different stories and who are ready to work and play hard as we do. Thank you, guys.
Hi, guys. Good afternoon. My name is TJ. Don't worry about the whole thing. It's going to give you a tongue twister. I work with FINIXIO. We're one of the biggest affiliate marketing firm in the world. I'm not going to bore you to death with the details. If you want to find out what FINIXIO is, just go see George and Amin right there. They will tell you all about it.
Awesome. So, hello everyone. My name is Anton Golub. I'm a partner at Full Stack Ventures. We are VC investing in early stage crypto and Web3 projects, and I run a DAO in Switzerland called Swiss Asset DAO, focusing on real world investments.
Hello. Yeah. Hi everyone. My name is Mark Quimsiam. I am the country manager of GIA Corporation for the Philippines. We are a micro-lending blockchain-inspired company doing MSME financing in the Philippines. I'm very passionate about financial inclusion. Thank you.
Thank you, gentlemen. And we'll just start with the very basics and fundamentals. So, Anton, I'll start with you and Mark. If you had to very, very simply define DeFi for our audience by cutting out all the jargon and simplifying it in just a minute, how would you define it? Anton?
Yeah.
You invest, so you put your money where your mouth is.
Well, not all of it in DeFi, because it's very risky. But so the easiest way to explain decentralized finance or DeFi is products and services in which you as a user don't have a counterparty. So to explain, in the real world or traditional world, when you use financial products like lending or borrowing or investments, you always have a counterparty that offers that services to you, and your risks are with that counterparty. And I mean, something that everybody here can relate to is when a bank offers you these services. A bank can offer you an account where you can hold your money, or a bank can offer you a lending product. Yeah. Now, that's great because that's something you're familiar with, but our experience and history has proven and shown that these banks can actually bankrupt out of nowhere. So one of the reasons why we are here today actually is because of the 2008 crisis, when some of the world's biggest banks bankrupted within a very short time period because of the risky activities they did. And that was the inspiration for the birth of Bitcoin, later on Ethereum, and so on. So to explain it again, in DeFi or decentralized finance, where you have a borrowing and lending product, your only counterparty is the code or the algorithms that enable you to access this product. Now, you can argue, are there risks in DeFi, the same ones that there are in the traditional finance? The answer is there are risks. But today, the risks in DeFi space, so this is why we as a VC don't invest all of our money in DeFi, actually. The risk is still that it's a very immature industry. These products are still very early stage. You're exposed to product risks, to code risks, and the end to these services just being a scam, unfortunately. And the reason why that happens is because these products are not regulated, So in traditional finance, banks are regulated, lending products are regulated, but this doesn't exist in the DeFi world.
Thank you, Anton. Mark, you want to add to that?
Pretty much Anton covered everything, but in simple terms, it's really more on having that secured smart contract between two parties. Let's say, for example, they've talked about in the previous panel a real world use case, which is probably lending or whatnot. So you have someone in the US can transact with the use of smart contract, underwrite someone in the Philippines who they don't know, but the transaction is safe, secured, fast, and efficient. and very transparent. So that's, DeFi in simple terms, I would say.
Thanks, Malik. Sorry, just to add to that, quick one. Like how I explain it to mostly Gen Z's DeFi, it's like going to a party and everyone brings their own snacks and beers, but instead of going to a house, you're going to have a party on the blockchain. And we don't need a bouncer for this party. And if everyone's trying to crash the party, the smart contracts will kick them out. That's just my understanding of DeFi.
That's a nice one. So we're already getting into the nuts and bolts, and this is really a topic on which we can go on easily for 2 hours and still scratch the surface, but we have such limited time. We heard two key terms come about: counterparty risk and smart contracts, right? So before I go into that, I'm going to go to Ilya and TJ on this, and again, I'm going to have some fun, put on my skeptics hat as well. We heard Anton speak so passionately about 2008 crisis, and I have been a former banker in my life. I was a banker at Citi during the 2008 crisis, so seen it firsthand. And I still remember that Friday and the weekend very, very distinctly that you've seen in the movies. It was real life for me. So we've all come, we've spent 15 years bashing banks and calling out their greed, and they've come a long way in terms of compliance, etc. since then as well. But TJ and Ilya, do you find it ironical that the very idea of decentralized money that was articulated in Satoshi's white paper after this crisis, as much of a political statement and a rebellion against the established system as a financial instrument, 15 years later, more than 90%, if my data is not entirely out of whack, of crypto transactions as well still happen through centralized exchanges. So is it interesting? Is it strange? Is it ironical that in a space which originated in trying to democratize finance, 90% of transactions, even today, people still trust a centralized entity. So as Anton said, counterparty is risky, but here it seems people seem to prefer counterparties. And counterparties which have grown in this space. So we are not talking about traditional brokerages, right? We are talking about the likes of Binance and Coinbase, etc., which are organic to this space. Views on this?
That's a pretty good question. I can only say here that true, decentralized finance is still an ongoing process. And the main challenge for the full adoption is the user experience, right? Because to be honest, now the user experience of fully native DeFi, it's pretty pure. So we need to improve it every day. We need to create different user-friendly features. And in that case, I guess it would be fully democratized finance, as I understand.
Just to add to that, and it's a very good question, Malik, actually. I guess SECs or centralized exchanges are going to be the key. And the reason for that is literally the ease of use. Because let's be honest here, how many, well, let's say the audience here, how many of you have used a DeFi platform in the past? Raise your hands. We've got 2, 3, 4, 5. Okay, we've got 5. So the rest of you guys, you probably don't know what a DeFi platform is, or you never came across one, or you never used it.
And again, TJ, just to add, this is a very, very skewed audience here already. If you probably ask this question to a broader audience, you'll find less than 1%.
Yeah, I know. That's what, so exactly the reason. The point here is that the centralized exchanges are easy to use. Like literally 2 clicks and you can buy. So yes, the DeFi, the whole DEX scene, the DeFi scene needs to improve, and people, the audience, the normal everyday people needs to get educated on it so they can actually use it with a simple ease. But at the same time, if someone who is a teacher works 9 to 5, they don't really care if they use Uniswap or SushiSwap or Coinbase. For them, they just want to invest some money in Bitcoin. So for them, a centralized exchange is probably the better option because they're not looking to trade, like, they're not doing a high frequency trading, or they're not looking to trade shitcoins. That's personal views on that.
Maybe I can just say, so first of all, I agree that DeFi...
I was actually going to come to you and throw this back at you.
Thank you. We read each other's mind, you know. So it's indeed the case that DeFi platforms have a challenge with user experience, meaning it's not so smooth. But I really want to go back to counterparty risk. So for those of you who are in the crypto space, you know what I'm going to say. For you who are not, In November last year, the second biggest exchange on the planet blew up, bankrupted because it was a scam. And I'm not saying that the decentralized finance can fully mitigate those risks, but it's very, very difficult to do a scam like FTX did in decentralized finance. So it seems that we as human beings, we as people, want to learn the hard way. So we're learning the hard way that centralized finance solutions have a problem. That problem is counterparty risk. As we will keep on losing money until we actually find the user experience and the products that enable us to use DeFi and to mitigate the counterparty risk. So I don't know if that's the question you wanted to ask me. But
yes, it's on those lines, and I'm going to come to you, Mark. So, again, continuing with counterparty risk and its, opportunities of eliminating that, and smart contracts or algorithmic way of settlements. You did mention about the second largest exchange blowing up, and I remember that was the only thing we were discussing late last year during the blockchain conferences. But Mark, coming back to what Anton referred in terms of human nature, he seems to suggest, and not just suggest, again, he's a VC, so he puts his money where his mouth is, but the algorithmic world or algorithmic models are inherently more safe in his worldview because there is no scammer or there's no deliberate scamming on the other side. And yet, we somehow as humans still want to engage with someone, even if it is buying and selling of a decentralized product or a product which has emerged as a rebellion against the traditional finance world. We still want to buy it through a Binance or a Coinbase or an FTX or a Kraken or whatever. Is it that we simply just want someone on the other side, we trust someone on the other side more than lines of code?
So,
let it go and then you can add.
Yeah, well, for me, yes. It's more of the relationship, the trust that you build with the person on the other side. Again, it's more of where should I put my money? Where should I invest my money? I want to make sure that I invest it in someone, not really an entity or whatnot, but someone whom people also trust in that same space. So I think that's yeah.
So I agree with you. People do want actually they want a person. They don't want a company. They want a person that they can relate with, and they want to trust that person and then invest in deploy the capital with them. But also, to be honest, DeFi and the products they offer is very, very young, actually. So the first Ethereum as a blockchain was launched in 2014, 2015. This is even after Coinbase, the world's largest crypto company, was founded, actually. So DeFi didn't really have its time to build the brand, to build the trust. So let's give DeFi a bit more time. And I think then we can build that trust and people will use the services, which are 100% sure.
Thank you, gentlemen. Again, a very interesting conversation so far. And as a former banker of more than 20 years, it's quite funny, back in the 2000s and 2010s, way back then, we used to say, the world is changing, the world of finance is changing, technology is changing everything, and the era of the relationship manager is over. And yet we hear from one of the leading VCs in one of the most innovative finance spaces that people still want to engage with people rather than algorithms. And not just in the DeFi space, many of us have seen this in the robo-advisory space as well, right? Somehow a robo being an advisor versus a human being an advisor. And I've seen the other side of that as well. A human can be greedy, at least an algo proceeds the way it is programmed to be, or it is learning from the algo. So, some great points both ways here. I'm going to now go to TJ and Anton. We saw a huge hype cycle, as happens with any new fascinating technology, back in 2021, where DeFi became this hottest new thing, and people were talking about how many billions have been staked, et cetera, and all these concepts of liquidity pools and exotic products, which again I find it slightly ironic. Derivatives, et cetera. The 2007-8 banking crisis was blamed for products like CDOs and CLOs and those so-called financial engineering products. And I don't know if many of those financial engineers have just come to this space, sensing it's the future. But how do you see this space emerging out now that we are just about, and I don't know, it's still early, but we just seem to be emerging out of this rather brutal winter 2.0. How do you see the world of DeFi changing from 2020 and 2021? So pre-winter to post-winter.
Well, that's a good question, Malik. And again, with the hype thing, and it's not just DeFi, like we had NFT hype, we had blockchain hype, we had crypto hype. In 2020, when COVID hit, we even had stocks and shares hype. Like, I'm sure if you remember GameStop and A&B, like, it blew my mind. But with every hype, how I look at it is like, the hype is like, it's a correction. Because every hype, when it comes to bear market, it's just going to wipe out all the projects which are, let's say, not sustainable, which are not doing things right, which are not there for the long run, or they're only looking to make a quick buck. So every bear market is going to wipe them out. And what I usually say is, if a project that comes out in a bear market, there's a higher chance of them succeeding. So I look at the hype is like a cycle, and we need a cycle. It's never going to be a straight graph. And obviously, like Anton mentioned, DeFi is still at its early stages. There's going to be a lot of bumps along the road. There's going to be a lot of trial and error. There's going to be a lot of hiccups. But what I know, the future, DeFi is the future. Because at the end of the day, I control my money. It's my wallet, my keys, my asset. No third parties controlling it. My money, my asset. That's it.
So before I go to you, Anton, and this, I want to take it as a follow-up, or rather going deeper into this. I'll ask you, Ilya, to join as well, because you are into research. And Anton, you're obviously investing in some of the, hottest new technologies or innovations in this space. Coming down to the nuts and bolts, and beyond these nice statements, coming down to the nuts and bolts, from a business, and the 3-4 challenges which are usually associated with DeFi, in terms of compliance, regulations, the very algo and the code itself, but also the business model, right? And I could go on and on and on about how many of these so-called discredited former leaders, I've actually had the, misfortune or of sharing the stage with them at similar conferences during the hype days. And they were the rock stars of the stage when they used to talk about how banks will die and how their platform gives a 40% ARR and yield and all of that. And I just had one simple question to that gentleman without naming him. Please explain to me how your platform will make that revenue on a sustainable basis. What is your business model? And I got some very roundabout answers. So Anton and Ilya, do you see some of these very fundamental questions being addressed? Because we usually say in this industry that these winters are a good way for the riffraff to be segregated and for real fundamental solid players to build for the next 10 to 20 years. So what tangible, specific changes in business models, maturity, robustness, whatever you like to call it, has come in this space vis-a-vis before, where everybody was offering whatever they wanted, but nobody had a clue about how they're going to sustain it? Or most people, let's not say everybody, but most people were out there making statements rather than looking at how they're going to sustain.
I would say, first of all, you shouldn't trust a company which offers you sustainable 40% API, right? And the main challenge here is to create a simple, sustainable business model. So at least you should earn in a sustainable way. You shouldn't just push your token and just nothing after it. The good model here could be JMix, for example. It's the DEX operated on the Arbitrum blockchain. I'm sure you all know it. And they just implemented a simple model called real yield model, and it shares their trading fees with the token holders, token stakers. So it's pretty not so much sustainable, but much more sustainable than different inflationary models. So first of all, you need to have this model. You need to have a real use case. So you need to have or just a DEX, or you need to have just okay, let's say a game, but this game should create the real value for the users. I guess that's pretty much it.
Yeah, so just to mention what you say, if we are looking at a crypto project and they cannot explain in simple words how they're going to make money, then this is not a business case. I mean, this is not a long-term sustainable investment. So if they're pitching you a token and the token price will go up and somehow that will make the business, this is not an investment or from a VC perspective. So I put that on the side. Now, in terms of making business models sustainable. One of the key narratives that I'm personally bullish, but also at Full Stack Venture, is investments into real-world assets as a trend in DeFi. So a lot of capital so far has come from the traditional world into the crypto world. So think about purchasing your Bitcoins, Ethers, cryptocurrencies, and so on. Now what has happened is there's a lot of capital in the crypto space, and that capital wants access to products in the real world. So to give you an example, one of the biggest crypto projects in the world, called MakerDAO, they invested around $800 million into US treasuries. So they took a lot of capital from the crypto space and they invested it into US treasuries to get yield, to get returns from a real world product. So this is a big narrative, big trend for the next cycle, and that we are very bullish on is how can you offer a product where people in the crypto world can access financial products in traditional finance. And this is such a massive trend now that's happening, starting off with some very simple products like US Treasury, so this is government bond, but it can also be financing micro businesses actually. And the reason why this trend is very important is because we have a lot of capital now in DeFi, a lot, and this capital wants sustainable long-term returns, but they're searching for it in the real world.
Thank you. So basically, taking advantage of the liquidity in the DeFi world and marrying it with the TradFi world, I think some of us are beginning to call it hi-fi or hybrid finance, whatever. Hi-fi has a nice ring to it. But let me go a little deeper. And again, in my role as an academic and as a professor, I always tell my students to really ask the most, go down one level and ask the most fundamental questions. So I'm going to go a little deeper, TJ, to you and Mark. That's a great articulation, Anton, but one thing which I think many people in this industry, and again, pardon me if someone feels offended, seem to miss is it's a very different macroeconomic environment in 2023 versus what it was in 2020 and 21, right? In 2020, we just emerged out of the pandemic. The Fed and the central banks opened the tap like there was no tomorrow. Their balance sheet ballooned to, what, $7 trillion, and money was available at 1% or less. So the risk appetite was extremely high. And TJ, you spoke about GameStop and all these meme stocks and everybody and their Reddit community coming in to do short squeeze and giving it back to the big bad hedge funds and all that. Great, that was a time and that was a phase. I think, at least in my lifetime, I have not seen such a dramatic surge in interest rates as we've seen in the last 18 months. The Fed, dramatically moving from 1% to, I don't know what they're talking about, but perhaps the terminal rates of closer to 5.5%, right? We don't know whether they're done with their hikes or one more is left, but we've come really, so it's not that we've not seen 5-6% in the past. When I was a child, we did see 6%, but that was gradual ramping up. Today we are seeing the Fed, just as they opened the tap, they are beginning to close the tap and hike interest rates as if there's no tomorrow. And we saw this impact a few months back with the likes of Silicon Valley Bank, etc. So even the mainstream banking system, felt shook. So my question is, when you say, Anton, that there is a lot of liquidity in this market and that can be deployed to real world assets, security tokens, whether it is real estate or agri or whatever, many income generating areas which can be tokenized and you can marry the real world with the world of DeFi and tokens. How is it so, different in your view, TJ and Mark, from an era where your US treasuries or the least risky instruments could give you only 1%, so the risk appetite was high, versus now when if the US treasury, the safest instrument in the world, gives you 5.5%, is there or will there be as much appetite, even if you bring in real world assets and say, okay, I'm going to tokenize real estate and give you 6 or 7%, at least institutional investors might say, I'm happy with 5% in US treasuries. So how do you see this and what is the road ahead for this industry?
So it's two parts there, Malik. First of all, you mentioned GameStop. I remember I studied finance and I was questioning my whole degree at that point. I was like, what the hell is going on here? I couldn't understand anything. But in regards to the Fed rates, the rates increase at the moment, like you're a banker. I'm sure at 2020, when they opened the floodgates, you will probably know this is coming. Like, it's going to happen. 1 or 2 years down the line, we're going to be paying for all this. And it's exactly the same scenario. So anyone who was studying economics back in 2020, 2021, they probably would have shorted a lot of stuff back then, and now they're probably just living a very wealthy life. In regards to, obviously, like DeFi world, and like Anton mentioned, because it's still early stages, there's a lot that needs to be done. There's a lot of things that can be done, and that's coming. Like, we already have DEXs, we have yield farming, we have staking, and again, now I'm not talking about 80% returns here, but for example, if you're staking, let's say your stable coin, and you're getting 12% or 13%, you're already beating inflation, which is still better than if you, let's say your bank is giving 5%. Yes, some people say, oh yeah, but my money is safe at 5. Is it really safe? Can you get out? You probably can't, or it's going to take you, what, 6 months to a year, or even more, if you get it out. And again, like the point Anton mentioned about researching the project, actually Mark mentioned as well. It's like, I go back to the traditional finance days and the old investment theory. Investing in anything, whether it's DeFi or crypto or NFTs, it's like buying a house. You don't just buy a house because it looks good on the outside. You're going to do your research. You're going to go in. You're going to check under every carpet. You're going to make sure every door works, every door hinges work. And then you're probably going to end up buying that house. Same thing with investment, whether it's DeFi or whether it's you're investing in treasury, it's totally up to you, but you're going to do your own research and make sure you know what you're doing. And like I said, DeFi is just going to evaluate over the coming years, and we're going to see a lot of great things happening from there. Personal views.
So Mark, do you align that 11-12% in a token which can be staked versus 5% in a US Treasury, which at least from an institutional investor perspective, whichever institutional friends I have spoken to, they seem to be more comfortable with that. Is this a real macroeconomic setback to this industry, or is it finding its way around? And Anton, please, again, because you are a VC, feel free to jump in and share if you're seeing some real innovations or some workarounds happening in this space.
DeFi currently is a high risk, high reward space, right? So the investor has to make sure that he is in this space for the long run, and not just for a quick hit. So the investor has to make investments, real investment. So that investment is it's investment on education, adoption, and not just really selling how this product works. It's really more on convincing people on how to use your product and how to use your the smart contracts and whatnot. So, with regard to the number, there's really, from my perspective, as an investor, or if you're an investor, there's really no number when you invest in DeFi. It's really you are investing in the future, and what's in it for you at this time. Maybe it's a loss, it's a gain, but you're again in it for the long duration, for the long term, and see it through, and not just get a quick hit, get a quick return on your money and whatnot. And going back to the investment on education, you really have to make sure that people are educated how can they use DeFi in real-world application, like what Anton and TJ have mentioned, buying properties, micro-lending, even probably in the future buying cars and whatnot. And just like the other panel said, buying land, and so on and so forth. So there. Anton, you want to add?
Yeah. So first to mention is that it's unbelievable how big of an impact the central banks have on the whole world. So you have 10 old men in a central bank saying the interest rates are zero. We have printed so much money. We have now huge inflation, and we need to raise interest rates from 0 to 5.5% or 6 almost. And now we are here talking on a DeFi panel how that's an opportunity for the DeFi world, because last year in DeFi you could get 10%, but treasuries were 0, and today's the yields in DeFi are 0 because it was not sustainable, but the yields on treasuries are 5.5%. So it's just unbelievable how these people have such a big impact. But now when we reflect on it, and we have to understand now this impacts even us as a VC from that perspective, because when we raise capital, we actually tell to people we invest in 100 companies, 2 will become unicorns, and it will go to zero, and that's why you get your 10-15% yield over a couple of years. But professional institutional investor asks us, but why should we invest in you? I get 6% risk-free if I put in US Treasuries. So we have all of these macro cycles. We have central banks impacting the world. And the question is, can DeFi offer us something where it's more sustainable and less risky, let's call it like that, than the real world? And the answer is yes. As you might know, Ethereum has moved from proof of work to proof of stake just recently. And if you stake your ETHs actually, the tokens, you can get around 8% yield now, and you get that reward because people are mining blocks. And I think in terms of, like I was saying, let's take the crypto liquidity and put it in the real world, but I'm also saying there's a lot of liquidity in the crypto world that's deployed in DeFi products in the crypto world, I guess, again, and that's taking Ethereum actually.
So Anton, I feel your
I want to be the best student, so I'm really diving in, you know.
Thank you. I mean, I should call you as a guest speaker at one of my
Just a quick jump in,
lectures.
if I may, for what Anton just said.
Sure.
Anton, you mentioned about Ethereum staking, and nowadays it's pretty reasonable to pay attention, especially for organizations and big players, big whales, to such restaking solution. It's and or so-called LSDs, liquid staking derivatives, special products which work on top of your Ethereum staking. The last example is the recently launched EigenLayer. In simple words, it helps you to improve, to increase your yield on top of your stake Ethereum. And if we are waiting for the next bull run, and these fundamental tokens like Ethereum will rock, so it's pretty good. But of course, not a financial advice.
So thank you for that, and I know we wanted to cover that. We are just about running out of time, but I'm going to spend 1 or 2 more minutes, Olga, if that's okay. Ilya, you spoke about these exotic instruments, and I mentioned somewhere in the beginning about financial engineering. You spoke about LSDs, etc. I'll open it to anybody who wants to take it. Does it sometimes feel like deja vu? The more the things change, the more they seem to be the same. This industry came about as a rebellion against the financial engineering of the 2008 world. And Anton, while you were speaking, I could actually feel your anguish about these 10 old men sitting in their boardrooms and deciding whether the balance sheet and the money supply should be 7 trillion or 4 trillion, whether the interest should be 1% or 6%. But tell me, there's this old saying on Wall Street, don't fight the Fed, which is perhaps taken as a, the most self-truism. Is the crypto and the DeFi industry also now coming to terms with it, that as much as we want to move away from centralized and trad finance, we can't fight the Fed on one hand? And two, to your point, Ilya, about these exotic products like LSDs, etc., the whole 2007-8 crash came about because too many Wall Street product managers were building these exotic products and CDOs and derivatives on top of derivatives on top of these junk loans. Are we at a risk of this industry repeating the mistakes of TradFi? We'll just conclude with that, if any of you, or do you think this industry has really learned its lesson over the last 2 winters and it will avoid the pitfalls of TradFi? If anyone wants to answer in closing, please feel free.
I would say about the second question. I think we can apply here a simple Metcalfe's law. So, as you know, it's the law of the critical mass of users. Unless we don't have this mass adoption, all this user-friendly stuff we just discussed, so there are still these risks. So this crypto crash can easily repeat. But if we're talking about sustainable models and at the same time critical mass of users, so I guess potentially it would be a better future than now.
Anton, I'll give you the closing comments, but just one quick note on that. Again, VCs are always known to hunt for exponential opportunities and network effect, right? Ilya spoke about this, whatever you want to call it, critical mass, tipping point. I like to call it that 1 billion test, or in the previous panel I mentioned that when Facebook launched its threads, it got 100 million signups in a matter of weeks. So when technology has to catch on, it catches on like wildfire. As a VC, do you see this industry coming close to that dream of critical mass tipping point, or are we still more in the experimental stages?
Yeah. So first to mention, when you were talking about traditional finance, I worked actually, before I entered into crypto, I worked at a big hedge fund in Switzerland as a trader. And it was an amazing experience, but after a while I thought, like, what am I doing with my life, you know? I'm a trader making rich people richer, and is this really what life is about, you know? And now I wonder, after 10 years in crypto, what are we again doing? People are speculating in crypto, and sometimes I wonder, is this really what I want to do in my life, you know, speculating, trading? But, you know, back then in the hedge fund, my boss, who was a very old gentleman, he used to tell me, Anton, this is human nature. People want to speculate. Some people will have real needs, but many people speculate that you cannot fight it. So today I'm a bit older, so I tell to younger people, I say, people want to speculate. Some people have real needs, but that's just how it goes. So let's, you know, build products for everyone. Now, in terms of where are we at that tipping point? You mentioned AI and ChatGPT, like how big of an inspiration they are. But AI has been around for like 30, 40 years. It just never worked, or it was not really user-friendly, and there was no use cases beyond specific niches. Today, anybody can log into ChatGPT and use it, like I use it as well. So let's give crypto another 30, 40 years, hopefully not that long, for me as an investor. But in terms of, from an investment perspective, as a VC, we're such in an early days of blockchain that it's very hard to explain it. So internet, 80s, early 90s, this is basically where we are in crypto. So we invest like that. You know, we are far away, and we need to onboard that billions of users, and it's going to last longer than a couple of months, like with ChatGPT.
Thank you. So if I had to conclude, we are still at the early stages. We are getting there, and if the industry learns from its mistakes, focuses on the right kind of use cases, and as we discussed on the previous panel, then the tipping point might be closer than what we think. Thank you so much to all the 4 panelists. It's great discussing with all of you. Thank you. Olga, over to you.